All right. Hello, everyone. Happy Monday. Welcome to your weekly market check-in here with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith, the head trader at T3 Trading Group and the leader of T3 Live's ProDesk virtual trading floor. Derrick, before we get into any market discussions here, just a look at his current positions as of our recording here today. Again, Derrick is the head trader at T3 Trading Group, and so we just need to show these for disclosure purposes. Our topic today, Derrick, is does inflation matter? As it is another inflation week. So first off, how is your Monday going in this new week for you?
Going. P&L is down a few bucks because of my short swings, but my intraday trading has a 100% success rate thus far today, so that's helping to offset it a little bit. But yeah, we're having an up day today despite that jobs number on Friday. Just market continues to impress as all news is good news.
Yeah. All right. So I did want to first talk about that jobs number on Friday. You're the first trader that I'm talking to since that number came out in the public here. Of course, I've talked to a bunch of you behind the scenes, but we got a really weak jobs report. What was it? 22,000 was the number, and I think the expectation was 75,000. Kind of the whisper number, 60 something. So missing pretty big expectations, official expectations, or the whisper number. Initially, got a bit of a market rally off that report because all right, really weak jobs market, getting a Fed rate cut for sure. Back to talking about the possibility of maybe 50 basis point rate cut. And then the market gave up all those gains. What did you think about the market action post jobs report on Friday and the inability to hold that rally when it came to the end of the day?
Yeah, I mean, the S&P did close negative on Friday, but that was you can't even call that a sell-off. And the Nasdaq and the Russell
Okay,
both, I'm
not
pretty
a sell off
sure.
at all. Yeah.
Yeah, I'm pretty sure that both the Nasdaq and the Russell even closed positive on the day on Friday.
Mm.
So we did sell off of highs. The initial reaction was up, which was definitely contrary to my thought process. I mean, I thought that that job number was about as bad as you can be, and I do think that bad news is good news right now. I also think that good news is good news right now. We're in a really interesting environment. So, and this is kind of what I was telling the team ahead of the job number is that we're in an environment right now where bad news is good news as long as it's not too bad. Because a little bit of bad news means that we're getting more Fed cuts, and the market loves it. Good news is obviously good news as long as it's not honestly too good. Because if we get some good news, it means that the economy is not massively deteriorating. At the same time, you're probably still going to get some Fed cuts. So the only time that you can really run into a problem right now with some of these economic numbers with the jobs number in particular, and we have a jobs revision number tomorrow. It's also going to be pretty important. Is if the number is at an extreme. If it's extremely bad, then the market probably sells down because the view becomes, yeah, we're getting Fed cuts, but the economy is deteriorating just so fast, so badly that these Fed cuts are going to be too little, too late. Or actually, if the number is extremely good, the market might also view that as bad because then there is no point in cutting interest rates in a really strong economy, a really strong job market, especially as inflation has been shown to tick higher. So it's a really weird environment right now. I think with news where it's like a little bit bad, a little bit good is good for the market. The extremes on either side are potentially bad for the market. The question then becomes, at what point do we consider the number to be extreme? And I would have thought that that number we had on Friday was missed by so much that it would have been more towards the extreme side of things that actually would have led to a little bit more of a sell-off. And I wasn't right on that thought process. Like you said, we initially ripped higher, and then even though we did roll down and the S&P closed negative, it was by no means a sell-off that I think justifies just the degree of deterioration in the economy. All that happened was the market priced in even more Fed cuts. There's chatter of a 50 basis point cut in September, which I personally think has no chance of happening pretty much. But maybe more importantly than that, there is a kind of a revision higher in the market's dot plot of expecting more cuts in 2025 and 2026. So while I thought that the number was really bad, it wasn't so bad that it was able to counterweight the benefit of the additional Fed cuts that the market is now expecting. Personally, I think that the market's got it wrong. What I just said is a very, very dangerous statement. It's one thing, I think, to think that the market can be wrong, but you never want to act on your thought process that the market is wrong. And it's definitely something I've learned over the course of my career. Let the price action dictate what you do. And if you look at the S&P, especially if you look at the Russell 2000, there's no way I can look at a daily chart of the indexes right now and make an argument that these indexes are bearish. So while they are bullish, you have to respect that. The trend is your friend. What this also does, though, Friday's number, is I think that it increases the importance of this week's CPI, because now that the market is pricing in even further additional cuts because of how bad the job number was on Friday, you need to make sure that inflation isn't blowing out to the upside, because then that will revert right back down. And then you're really in a stagflation situation, which at a certain point, I think the market has to recognize stagflation as the ultimate worst case scenario, because that then becomes a situation where the jobs market is weakening, the economy is weakening, and the Fed doesn't really have any tools to do anything about it, because their tools are just going to further increase the inflation problem that we have. So all that I think happened on Friday, I'm a little bit surprised that we weren't weaker. I'm still broadly bearish, even though the technicals are not confirming it. I'm waiting for technicals to confirm it. Um, I think that all that happened on Friday was we just increased the importance of the CPI this coming Thursday. If that number comes in really hot, look out below.
Hmm. All right. My next question was about the CPI, and we got a question from Cyril on YouTube. What are your expectations from CPI? Real quick, this week's number is backwards. PPI is on Wednesday, CPI is on Thursday morning. I never understand, you know, they do it one way and then the next month they do it a different way. So, meh, I don't know. I think it's about like
I'm
number of
not
days between the reports or something
I
like that.
I'm not
But
100% sure. I thought it might have something to do with the holiday that we had at the beginning of September, but I'm really not
yeah, it
100%
might
sure
be.
why that happens occasionally
Right.
either. So yeah, CPI on Thursday. You know, the interesting thing about the CPI on Thursday is that the uptick in inflation that we've seen in these last couple of reports has mostly come from services inflation, hasn't really come
Mhm.
from goods inflation too much. So I'm watching both sides of that, goods inflation and services inflation. I keep seeing these really important S&P 500 companies like Procter and Gamble, like Walmart, like to some degree even like a Home Depot, saying that X percentage of their goods are going to be going up in price because of tariffs. And it keeps kind of getting pushed forward a little bit. Like I think they did a good job kind of building their inventories ahead of time, but it should be starting now in August, September, and October, where we are seeing an increase in goods inflation related to those tariffs. So I think that the market is pricing in a 0.3 or 0.35% increase on the CPI. I won't be surprised, just based on some of the other numbers I've seen recently that have been not as important numbers, but are indicating like stagflation, like some of the ISM numbers that we've seen. I wouldn't be surprised if the number comes in hot and therefore the risk really becomes to the downside of the market. I mean, you have to think that the risk is the downside on this, because the market at this point is pricing in so many cuts. There, I think the market is pricing in a situation where it's not taking into account that increase in inflation anymore, and that stagflation situation hindering what the Fed's able to do. So therefore, I think that a hot CPI drives the market lower to a larger degree than a cool CPI drives it up. But, you know, whenever it comes to any sort of binary event like this, an economic number, an earnings report, you just never know. You never know what the number is going to be until it hits, and then you still don't even necessarily know what the reaction is going to be. You can take a good, you know, educated guess. It's a lot of what I do based on the current situation and the flow of funds and all that fun stuff. But you know, there's no way we can know until the number actually hits. But I think that the risk is to the downside on a hot number. I think that there is a okay probability of us seeing a little bit of a hot number.
Hmm. This is the first. Inflate. No, we got the PCs. This is the first CPI though number to come out since Jackson Hole and what we heard from Fed Chair Jerome Powell there. I think the really interesting thing he said was, we are more worried about the jobs market and we're kind of willing to let inflation run hot because it'll eventually come down to what we need. So do you think the market gives a little bit more leeway to a kind of hot number with that in mind, knowing that the Fed isn't that worried about inflation, especially after such a bad jobs number on Friday?
Yeah, it's interesting because it's actually the exact opposite of what he had said like 3 or 4 Fed meetings ago, where he said that
Right.
the more important side of the mandate is price stability because you cannot have steady employment without price stability. And then we
Hmm.
saw a very different take from Powell at Jackson Hole, where he discussed a little bit more about the possibility of tariffs being one-off price increases. And I actually think that that's an accurate statement. I do think that tariffs are going to be more of one-off price increases, but they're going to be very spread out. Like I said, when you analyze the companies that have reported earnings recently and when they are saying that price increases are coming, you can just tell that's going to be very spread out. So we'll probably continue to see upticks in inflation that are slow and steady for maybe the next year or so. And at this point, I'm almost more worried about Fed cuts spurring inflation than I am about tariffs spurring inflation. 'Cause it does make logical economic sense that yes, we all know tariffs are stagflationary in nature. They're low growth, high inflation policies. The inflation side of that component, though, tends to be a one-off, right? If all prices are going up by 15%, then all prices work their way up 15%. And once they're there, then they're there. And that's it. You have a one-off increase on tariffs unless we were to continue to increase them and increase them and increase them over time. Which probably won't happen, right? We're probably going to get to our number and then stay there, and then the price pass-throughs just slowly seep their way into those prices. But if you start forcing the Fed, for lack of a better term, to do dramatic interest rate cuts. Well, interest rate cuts spur economic growth, but they also spur inflation. So it's not impossible actually for the real danger on the price stability side to actually come from the Fed itself in the form of those Fed cuts. Now, 25 basis points here and there, I don't think makes a difference, but the the Trump administration has talked about 3% cuts. I think if you get 3% cuts, you get 5% inflation. That's what I think that leads to. And there's probably a balance, honestly, that's somewhere in the middle of these extremes. What that balance is, I don't exactly know. But this now we're talking about like just a multi-year type of situation where big picture, what does inflation actually do to the stock market from a nominal return perspective? Not a lot, or you could argue that it's even potentially bullish from a nominal perspective. Where things get hurt are in terms of the real numbers, right? Um, it's like if inflation, I'm just going to make up a number. If inflation returns to 5%, the stock market could be going up 5% every single year along with inflation because inflation impacts everything, right? It makes the price of gold go up, makes the price of my groceries go up, and makes the price of the stock market go up because the dollar is worth less. Um, so that's how we need to think about things, right? In terms of real return versus nominal return. So you could get 5% inflation, you could get a stock market that goes up for the next 10 years, 5% on average. And then really what happened is that the market didn't do anything. It went sideways. But you still see that new all-time high getting hit, if that makes sense. So, I'm bearish on this market to circle it back to today. That's more of a positioning that's based on my understanding of flow of funds and where the systematic community is and seasonal weakness, especially in the back half of September when we get through September OPEX right now. But big picture, I don't trade based on real gain and loss compared to inflation, right? I trade based on how the market itself actually moves, if that makes any sense. So if inflation is going to come in and that's going to speed the market higher, even if it's no gain, no loss. Using my previous example, I want to be long that market. I want to be short that market. So just a lot of things that I've been considering and toying around in my head where I'm looking for a bigger pullback in this market right now, but there's a good chance that that bigger pullback is eventually a buying opportunity.
Hmm. I got a question from YouTube. Okay, do you think inflation still meaningfully impact tech valuations? So does inflation impact that? Or is AI's growth potential now a dominant driver of market
Yeah,
performance?
I think it's about AI growth that is where you see the tech valuations come from. The thing that I don't really have my gunpowder on today, but the thing that I keep thinking about in terms of tech and tech valuations is what happens when you get, we just had that NVIDIA report, whatever it was, a couple weeks ago. And one of the things that stood out to me the most, even though I kind of already knew it, and I wish I remembered the statistic to the number, but I don't. But it's something like NVIDIA has two customers that are 40% of their revenue. And again, I'm definitely a little bit off on that number, but that it was something near that, and that was what really stood out to me coming out of that news report more than anything else. Well, what happens if one of those two customers decides that the amount of spend that they have been doing for AI isn't being returned to them in terms of the revenue that's actually coming from it? Like, that's the big question. There's no people who know that AI is the future. AI is the future. I would say 80% of the time now, when I need to look something up that I would have previously Googled, I'm asking Perplexity. So there's no doubt in my mind that AI is the future, but the question that you need to be asking when it comes to the actual stock market and valuations and NVIDIA's run and Microsoft's run and Meta's run, the way that some of these Mag 7 companies have been moving, is does this actually translate into profit for these companies at the end of the day? Because at a certain point, and the example that I really like to cite is with Meta specifically. When Meta back in 2022, maybe it was spending like there was no tomorrow on the metaverse, and the market said, "Hey, we didn't really think that there's going to be a return on this spend." They eventually started punishing the absolute hell out of Meta as a stock. And then we got that quarter, I think in 2022, maybe late 22, early 23, where Mark Zuckerberg said that this is a quarter of efficiency. We're cutting back on our spending, and then the market ripped higher. Well, just using that as a metaphor, as an example, I don't think it's exactly comparing apples to apples. Like at a certain point, if you got two companies that are making up like 40% of NVIDIA's revenue, and one of those companies decides, hey, the hundreds of billions of dollars that we have been spending on these NVIDIA chips is not really returning to our bottom line, we're pulling back. Then what do you see? You see that not only will you, I think that you'll see like a compounding sell off actually in NVIDIA and AI, where not only are you losing the expected revenue growth, but you're actually also seeing a declining multiple at the same time. Not saying that that will happen anytime soon. I have no idea. Maybe it won't happen at all. Maybe the bull case plays out perfectly, and all of a sudden this turns into a lot of profits. But all of the research that I've seen, I think that there was a couple weeks ago, and this has kind of helped with some of the semiconductor weakness recently. An MIT study came out that showed that another one where I apologize, I don't remember exactly the statistic, but there's a very, very large percent, I don't know, 75, 80%, 80 plus percent of AI projects are just not bringing in the revenue and the profit compared to the spend. So when you're thinking about NVIDIA and you're thinking about big tech and you're thinking about their multiples, which I do think is something you want to have in the back of your head, I think that that's the bigger scare there, not necessarily inflation itself. In fact, there's a chance that higher inflation actually ends up being good for some of the Mag 7 stocks just because sometimes they're just viewed as safety plays. Like, I feel like people buy Apple stock now as quickly as they go buy treasury bonds in the event of fears of some sort of an economic downturn or something like that, because Apple's got more cash than most countries. So yeah, great question. That's my thought process on it.
You were pretty close. on that NVIDIA. It's customers, two NVIDIA customers made up 39% of their revenue in the July quarter. Customer A, 23%, customer B, 16%. So you said 40, you were close.
Not
All
bad.
right. Another question, and you and I obviously will talk about this more as we get closer to the Fed rate cut and where the market is, of course, going into that event, because as we all know, it's about where things are headed into an event, where things are going to move, as much as it is about the actual event. But Cyril asked if there's a possibility the rate cut will be a sell the news event.
Yeah, absolutely. I think if the Fed announcement were today and they announced a 25 basis point cut, that they would sell it. Because at this point, again, it's all based on expectations. At this point, I saw not a huge probability of 50% cut. 50 basis point cut. But I think I saw that there's like a 10% probability that the market's pricing in of a 50 basis point cut. And the reaction to that number on Friday was so strong overall compared to how weak that number was, that if you were to get only a 25 basis point cut, let alone a 25 basis point cut coupled with any sort of hawkish language, then I think the market actually gets smoked on it. But I'm going to say that out loud. It's also it's not just how much they cut. It's also going to be really important the language that they use around it. Are they indicating like, hey, we're just getting started. You're getting 2 more cuts this calendar year, and 5 in 2026. Like, and obviously, Jerome Powell's never as straightforward as I just kind of created this fake example. But if he were to indicate that he's getting out there and we're picking it off today with 25 basis points, expect a lot more, then maybe the market sells down a little bit because it was pricing in a bit of a 50 basis point cut. Maybe it doesn't sell off at all. But if it's more of a neutral tone from Powell or even a hawkish tone from Powell, then I think that we sell on it. So I think, again, it's an event where I think that the risk is to the downside here as we're getting into September. With that said, I was looking at some good charts and statistics from my partner Patrick Hawes' morning note. I think was sourced from Deutsche Bank, was part of it, that showed that while September is typically seasonally weak, the one time where you consistently get a positive September is when that September is coupled with a non-recessionary interest rate cut from the Fed. And that has happened, if I'm remembering correctly, 4 times since the early to mid 90s, including September a year ago, September 2024. September 2024 was a positive September, and all those other 3 or 4 occasions over the course of the last 30, 35 years have all been the exact same. That's when you get a positive September. So we'll see. Great question.
All right, good stuff. All right, we've got a comment saying, Derrick, please write a textbook of all your trading knowledge. Thanks, you guys are the best 9-year profitable trader.
Love it.
Derrick's always got good market insights. All right, Derrick, so here where we're at on this Monday, ahead of PPI and CPI this week, inflation that like doesn't matter but does matter. It's all just a bit of a what are some ideas that you like here?
So
On a screen share, we can look at some charts.
I guess you've gotten the tone from me. I just my problem right now is that I really don't like the market. I just really don't like the market with where it's trading right now. I think it's expensive. I don't like that expense is coupled with seasonal weakness. I want to get through this September and possibly even October period, and then reassess the market before I start layering into any bigger picture longs. What I've been doing recently has been the opposite. It has been recognizing and understanding that the market technicals are still bullish at the index level, and the technicals need to be my number one guide, but also recognizing that the leadership has changed, and I've been able to lay into previous leaders from these last several months that have now lost their leadership. So what do I mean by that? Let me pull up my screen share. Share screen, entire screen, boom. Okay, it should be up.
Yep.
Right. So what do I mean by that? Right? So look here at the SPYs. Uh, I didn't like Friday's candle. I thought that Friday actually was a failed breakout, so maybe this is the beginning of a change. But outside of a little bit of a cautious stance, I think that you can take from Friday's trading session. Overall, you can't look at this daily chart in the spies and say that it's anything but bullish. I mean, we're sitting a hair away from all-time highs. I do think Friday's candle is notable though, and I do think that Friday's candle put the market, the S&P and the Nasdaq, not the IWM, into a little bit of a penalty box because it's a failed breakout. But if through the jobs revision or if through the CPI or PPI, the market is able to get back below 650, get back above this high, which is 652 spot 20, then we are in full on bull mood. So the first thing I would say is I actually don't hate the idea of leaning through versus Friday's high right now, but respect the technicals. They're overall bullish. If you get above 650, 652, you got to get out of the way of that trade and let it potentially reset up. It's pretty much the exact same idea here with the Nasdaq, which is not making the same highs. The IWM, on the other hand, you do have a little bit of a doji on Friday, but that chart is super bullish, and this is what everybody's short, and this is what the CTA, systematic trend following community is actually still buying to some degree, as opposed to the S&P and the Nasdaq, where their positioning is extremely strong. So the leadership has changed. That's what I'm talking about, right? The IWM has just been a huge underperformer. And maybe I could even pull up, my partner Patrick, here it is. He publishes a wonderful morning note every day, a lot of great institutional research in there. And he has a chart here from Bloomberg that shows the Russell 2000 versus the NASDAQ 100. And it's a little bit tough to read on the dates here on when exactly this spike is occurring. But you can see that all of a sudden, very recently, there has been a spike of outperformance in the Russell 2000 versus the NASDAQ 100. So you have a different leadership here over the course of probably since like July, accelerating in August, accelerating in September of IWM leadership. But what had been strong off the bottom in May, June, July has now gotten much weaker, which is the AI trade. If you look at NVIDIA's chart, uh, it doesn't look like a nightmare. It's not like the end of the world, but this thing has kind of topped out and struggled at this 185 resistance, and now it's broken down through some support levels. And even as it's having a bounce back day today, to me, this just looks like a bounce back day from downside extension, and that this is not a bullish looking chart. If you look at AMD, which was a massive leader off of the April lows, dynamite in June, dynamite in July, this thing has really pickled out since its excellent report that it reported. And it just has not been trading well. And this was the earnings report back here on August 6th. I know it made one more new peak after that, but it has not been trading properly. It's another name that has really lost some support. 160 support, it got lost. I know that part of the reason for the weakness is ADGM's earnings Thursday after the close, which were really good and kind of indicated that they're going to be competing better with NVIDIA and AMD, so that has added to the weakness. But you can just look at the Palantir. Palantir, finally isn't trending higher. The Palantir is trending lower, but it's finally not trending higher. So the bottom line is, again, the SPY, though I do think you can be short versus Friday, cautiously short versus Friday's high. The Q is pretty much the exact same deal here. Overall, these charts look fine, and the IWM looks super bullish. What our leadership has weakened out. So I have been leaning into on the short side for the most part these names that are either one of two things. Either they're these old leaders that have weakened out, or I'm leaning into some names that are just getting like ridiculously extended to the upside for that pullback. And if I can ever get any market help, which is a big if, because this market feels like it's barely had a down day since the April bottom, maybe a couple down days at the end of July and through August. If you could ever get some market help, which I think if you ever are going to get market help, it's in September, especially the back half of September, then these names probably roll down a lot more. So even if you're taking a cautious stance against being short the indexes, there are some former leaders that have weakened out enough where I think that you can lean into those to the short side. And then if the index becomes more bearish, you're probably really going to get paid on them. And then you can also continue to be shorting the indexes when they show you kind of the whites of their eyes if they're actually breaking lower. So that's actually my thought process. I just don't like the market now. If you could get that big unwinding of like the systematic positioning, because they don't have anything left to buy, then at a certain point, I do still like the idea of buying a bigger picture dip in this market. But big picture, I just can't get myself to buy anything right now. Even the leadership stuff, like this IWM stuff, I struggle to be able to buy those trades for more than a day trade right now. I do still really like China. Alibaba's been on fire. I exited my Alibaba position into 140 this morning because that's been my target on my swing. So I got out of it, but I love the idea of aggressively buying dips in China and the Chinese names when they come in, they're really good. And then the other one, which is too late to buy right now, but I've been all over this gold, this GLD, and I still think this is going structurally higher as well. It's beginning to extend here a little bit, but this is just the ultimate long that you want to have on if you have any fear of inflation, if you have any fear of the Fed losing its independence, if you think that any of those things at a certain point in the short run negatively impact the stock market, gold is where you're going to see the rotation to it. And some of this move, I think, is actually just a front run on those expectations. So maybe that's what I'm saying. Be careful about chasing. But this is also people keep asking me to study the gold chart, and I'm like, no, I don't understand this. This seems like a structural change in the reason how and why gold is moving that we actually haven't seen come into this market in a very long time. And this could really go. If anything, I wonder if my 350 target on GLD is too shallow. Big enough picture. So that's some of the stuff that I like and don't like, which means I also like it as a potential short. So hope that helps.
All right. We'll end here on this question. Although you haven't liked the state of the market lately, what's your sentiment on this summer's intraday activity? Good, flat, seasonal norm.
So the summer activity has been very marked by dispersion, which I think is great for traders. It makes it more of a stock picker's market, right? So inherently, when you have a market where correlations are low and dispersion is high, the S&P doesn't give you big moves. It's not a great time to be an index trader. But if you're a stock trader, it's a great time to be a stock trader because you're going to have one thing ripping higher and even for something else to be able to go down. Like that's how dispersion works. If the market is stuck where it's ending, let's just say unchanged, and there's a whole variety of reasons why that can happen in terms of market structure, where you are much lower probability of bigger moves, which I kind of think that's where we are right now. By the way, until we get to September OPEX. I think it's possible that you could go into a grind lower, or of course, if there's a major negative news catalyst, then you could sell down. But barring that, barring a major news catalyst, this market should stay relatively stuck. Grind up, grind down, go sideways. But within the confines of that, if you get individual stock news that causes AVGO to gap up 10%, like it just did on its earnings report, then you like inherently need to have enough things selling down that day to offset the index so that the index is able to be unchanged. That's what dispersion means. What that creates is a stock picker's market. It's actually an environment where traders, long-term managers who are worth their salt should be able to shine because that's how you outperform the S&P. Like if you believe in benchmarks. And I'm a trader for myself. I don't manage money for other people, so I could care less about benchmarks. I don't care about beating the S&P or the Nasdaq or any benchmark. I'm trading for income and for a living, and I'm trading to take out paychecks. So it's a little bit different. But if you're like a fund manager right now, the dispersion is a dream for you because it gives you the opportunity to really be able to outperform the S&P. And if you're a trader, you don't have a benchmark to say, but it breeds a ton of opportunity when the S&P can't move, but you're getting big movements from individual stocks in either direction almost by necessity. So I think overall it's been a really good environment, but you got to keep your thumb on the pulse of things because a lot of these long short managers that I just mentioned should be thriving. I think are actually getting smoked because where they found themselves coming into this August September period, I've been making jokes about it, but it's kind of true. is long NVIDIA and hedging that by being through JOBY, or QS, or JUMAI, JMAI. Those names have been squeezing like crazy. Squeezing like crazy. So those fund managers who put on the opposite side of the team. Of course, you're a normal day trader. This is a really good environment, and you should be trying to thrive in it.
All right. All right. For our viewer who wanted a textbook from Derrick, he hasn't written a textbook, but he does have a free ebook that you can get. You go to t3live.com/do live. To get Derrick's free ebook, you'll learn some of his thoughts on trading, his strategies, and also the benefits of prop trading, how you can work with himself at T3 Trading Group. Again, Derrick is the head trader there. So all traders who work with T3 Trading Group get to interact with Derrick and his team on a daily basis. They're in the Pro Desk Virtual Trading Floor, which is our VTF for all of our pro traders. So again, Derrick, have a great rest of your Monday. I hope you get some good catalyst off the CPI this week, and maybe you'll like the market after Thursday. Maybe you'll hate it and you'll short it. But we'll see.
Thanks, Greta.
You have a great rest of your day and your week, and we'll talk next week. Have a good one.
Appreciate it. Talk to you soon.
All right. Bye.